We like to accelerate depreciation on rental properties, just like we like to accelerate depreciation on vehicles.
Cost segregation, yeah, talk about that. Explain that.
Yeah, so a cost segregation study is a really awesome strategy that we use for real estate investors to accelerate depreciation on the asset to force a paper loss. This paper loss is normally passive. So in order for us to be able to use it against active forms of income like W-2 or self-employed income from an S corporation or an LLC, most times we have to qualify the taxpayer or the spouse as a real estate professional. A real estate professional is someone who can show the IRS that they spend 750 hours in their real property trade or business or managing their own investment property. But the second part of the test is you have to show the IRS that you're spending more time in real estate than any other job you have. And for most W-2 taxpayers who are working 40 hours a week, there's no way they're going to be able to prove that they're real estate professionals because they would have to spend more time in real estate. It works if you have a spouse that's maybe a stay-at-home spouse that can be the real estate manager. But for most taxpayers that have both working spouses, it doesn't work. This is where the short-term rental strategy comes into play. You see, Airbnb and VRBO came out in 2011, maybe 2013. However, the passive activity loss rules were written in 1986. And back then, Airbnb and VRBOs weren't around, but they did have hotels and motels. And if you had a hotel or motel business that was being rented out for 7 days or less, you had an active real estate operation, which means you can take active depreciation against your active forms of W-2 or 1099 income, which means if taxpayers today run Airbnb businesses, they're no different than hotel and motel-like businesses, and they have their customers stay in the Airbnb or VRBO 7 days or less, you have an active real estate business under Code Section 469. This allows for taxpayers now to do the cost segregation study, to accelerate depreciation, and now they can take a loss against their W-2 or 1099 income. On an average investment property, you're taking around 30% of the building's purchase price as a year one loss. So if you have $1 million property, for example, you're putting down $200,000 down, 20% down payment, but then the government's turning around and giving you a $300,000 loss write-off on your tax returns. And if you're running it as the Airbnb strategy that we just talked about, you're offsetting your W-2 income or your 1099 income. If you have $300K in W-2 income, you're tax-free.
And that's specifically for investment property.
That's specifically for investment real estate only. You cannot depreciate personal property. It has to be investment property, held for investment purpose.
So here's the tricky part, right? Because what if it's new build, right? Like you have primary residence, but you're have a new build. Obviously, you have to apply for it as specifically primary or investment.
Correct.
But is there any fine line in between that you can use tax code, or it's pretty finite? Like this is your primary residence, you can't do it.
I mean, you can have a portion of your primary residence being rented on Airbnb or set up as an investment asset. We have clients all the time that will set up ADUs in particular states like California and Texas. And so the front unit is their home, and then the back unit is being rented out for real estate purposes. We take the square footage of that back unit and perform a cost segregation study based off of the square footage of that back unit and are able to accelerate depreciation in that light. Maybe you have a vacation home. Instead of you putting 20% down, you put 10% down because it's a vacation home. Because it's a vacation home, you're not there all the time. I might be able to use that property as a short-term rental for you, perform a cost segregation study, and now accelerate depreciation, forcing some losses on your tax return that can offset flow through from your S Corp or W-2 income.
Yeah, one of the things we did was the Augusta rule.
Oh, I love the Augusta rule.
Yeah, obviously, we tape in different locations.
Yes.
When we tape in Atlanta, we use that studio. Obviously, is it still up to 14 times?
That's correct.
Explain to the audience and how they can take advantage of it.
Yeah, the Augusta rule started by really, it was popular because of the Masters tournament that was happening in Augusta, Georgia. There weren't enough hotels to house all of the different tourists that were coming out for that tournament. So homeowners were opening up their houses for those 2 weeks and were providing housing at very high rates. The city of Augusta said, you know what? Our homeowners shouldn't have to pay taxes on this. So they disallowed it. If you're in the state of Georgia, we'll disallow for you having to pay taxes on the rental income that you're receiving during this Masters golf tournament. Well, the IRS loved that rule and made it a law the following year. We call it the Augusta rule or the 14-day rule as tax professionals. Many business owners have taken advantage of that law as well. What they'll do is they'll set up a contract between their S corporation and themselves, and all they're doing is renting their house to their business for 14 days to conduct business activities. These could be business meetings, business conferences, business events. As long as those business events are ordinary, necessary, and reasonable to the business in the pursuit of income, you are now conducting in behalf of the Augusta rule. I love this strategy because it directly puts money back in people's pocket without them having to go spend more money to save.
Yeah.
What's some of the mistakes? Like, what do you see that people get audited the most for?
Yeah.
Like, what's the mistake that they make as far as that's concerned?
Yeah. Most audits happen because people make omissions. Omissions means you left something off of your tax return. Most taxpayers who get audited are Schedule C business owners, sole proprietorships, single member LLCs. Why? Because they receive a lot of 1099s. They sometimes forget to report all their 1099s. And guess what? If you forgot to report that 1099, it got submitted. The IRS knows you received that 1099 and they match it up to your tax return and flag your tax return immediately. That is one of the biggest ways that people get into audits. The second is using categories on your tax returns that are essentially red flags to the IRS. For most single member LLC owners, the two categories that they like to use is other expenses and miscellaneous. To this day, I do not know what a miscellaneous expense is, but I know that many taxpayers who like to file their own tax return love to use that category. And other expenses, when you have other expenses as a category, that means you don't know how to really categorize the expense. So you're putting it in the category that the IRS set up for you called other expenses. And now you have to list out each line item of what those other expenses were. I have seen some of the craziest things, guys, on some of these other expense items. Massages for my team, baseball memorabilia cards. These are not ordinary necessary expenses to your business whatsoever. So why are they landing here? That gets you flagged and that gets you audited. And yes, Schedule C businesses are highly more likely to get audited, actually 33% more likely to get audited than S corporations or partnerships.
Man, that was triggering because every month I get that itemized sheet and it's a breakdown and I'm like, all right, I got to think about what that was. I got to think about like, yo, that's not my card. Let me figure. Then I'm pretty good with it. My memory's pretty good.
Yeah.
But yeah, you're 100% spot on. I want to talk about. I started because I'm like I got to ask him about the SALT deduction.
Yeah.
Because I don't think people are familiar with it.
Yeah.
I know that the rules have changed. As a homeowner, this is something that people can take advantage of. So break down what the SALT deduction is, how it's increased, and how we can benefit from it.
Yeah, absolutely. So SALT stands for state and local tax. If you are in a state that taxes you, or you are in a local municipality that taxes you, the government allows for you to deduct that off of your tax return. So let's just say that I'm here in the state of New York and I live in Manhattan. Manhattan has its own city tax, and then the state has its own state tax. I can deduct that off of my tax returns, but here's the issue. I'm limited to only $10,000 between state and local tax. Well, if I own a property here too, I may have $50,000 in property taxes this year. I might have paid $60,000 in state taxes, and then the city of Manhattan charged me another $1,200. I'm only able to deduct $10,000. Well, with the OBBA, we got an update.
Appreciate you for that.
Yeah, we got an update, and now it has increased to $40,000. There's a cap. If you're making over $400,000 adjusted gross income, you don't receive that $40K. It drops right back down to $10,000, but it still helps out a significant amount of taxpayers because most taxpayers make under $400,000. So if you're in a high tax state like California, Hawaii, New York, this helps you significantly. You're now able to write off up to $40,000 of your state taxes on your tax returns, property taxes, or local taxes, helping out many people.
So high earners, not going to really help. The average person definitely helps.
Yes. Does not help high earners at all. You will not qualify for it.
Good to know.
When you look at like the child tax credit, right?
Yeah.
Like that's something that a lot of people are not familiar with and don't even take advantage of. Like what should every parent know as far as that's concerned?
Yeah, the child tax credit is something that you should take advantage of as your child is underneath the age of 18 and they are someone that you support. You're able to get $2,000 per child, and that's a credit. It's not a deduction. Part of the reason why the child tax credit is so powerful is because many low-income households will have multiple children. And when they go to file their tax returns and report their income, they're getting back a sizable refund because the child tax credit is a refundable credit, which means if I only paid $8,000 in taxes, but I have $16,000 in a tax credit, I'm getting back $8,000 in a refund from the government. $8,000 when you're only making $40,000 a year is a significant amount of money that could support you and your family possibly for another month or two without you having to receive money from your current job. So for many low income households, the child tax credit is one of the most beneficial things that they apply for.
Let's keep it with the kids because I believe July 1st of this year, Trump accounts go into effect.
Yes, they do.
Yeah. This guy's good at marketing. So talk to us about that, the benefits as employers, how you can use this to your advantage. It's for every kid that is born in 2026, or is it every kid under the age of 10 as of 2026?
I believe it's for every kid that's born in 2026 moving forward, and for children who are currently under the age of 10 can apply for a Trump account.
Okay.
And get $1,000 funded by the government, and that money can continue to grow in a tax advantaged way. Honestly, it's great. I still favor the Roth IRA for your children. You can set up a custodial Roth. I think it's way more beneficial to have the custodial Roth, but why not just set up the Trump account for your child? That's money that's just going to grow. I mean, the analysts are already doing numbers on it. If you just let that account grow from the day your child is born to the time that they're, I believe, 62 years old, there should be close to about $800,000 in that account. That is generational wealth. So I think the Trump account's absolutely amazing. It's one of the many things that Trump kind of slid in there as a part of all the other updates to be able to bolster his presidential candidacy.
Do employers have the ability to match it, or is there still some clarity that needs to be like provided to us on that?
Based off of what I know, I don't believe the employer is allowed to. Actually, you know what? I believe there is a way in which the employer can match it for their own child, but I don't know about for the children of their employees. I would have to look into that.
Gotcha.
I would have to look into that. Yeah.
So you said like a high income earner can still be fragile if they don't transfer over to ownership.
Yes.
Like just because you make a lot of money doesn't mean that you're like, in a stable position when it comes to finances, when it comes to the tax code and just in general. So
correct.
Explain that.
Yeah. So there's a lot of taxpayers that make a lot of money, but just because they make a lot of money on paper doesn't mean they're taking home a lot of money. And a big reason why is because they're earners, they're not owners. You can be an earner in this, government, but guess what? They're going to penalize you for just being an earner. Or you can choose to be an owner, buy assets like rental real estate, oil and gas,